All right, good morning. For the record, it is November 17th, 2021. This is our agent-facing webinar series here to give you value and help you understand different facets of everything that we have access to and you have access to the people that you're working with. And we are excited to share this information. So my name is Nathan Klug. I am the managing partner of Praxis Agency Consulting Group, and we have a bunch of other of our affiliate marketing offices that are on here as well. So I want to recognize a few of them. So Wella Financial, Game Plan Financial. Who else do we have on here? We have Agency Growth Partners, and I think I'm missing a couple more, but wanted to welcome everyone to the webinar. Today's webinar is on living benefit business planning. So our focus, if you got the information for the registration, is on, we're going to go over one specific concept, but really getting into that small business world. It's one of the most underserved marketplaces out there. And a lot of agents are looking to get in that space or in that space, but need more of a competitive edge to be able to talk to business owners and help them out. And so that's really what we're going to be covering today, is helping you understand how to leverage the living benefit world into the small business world. And we have no one better to talk about that. I'm not going to give, I won't steal too much of his accolades. But Steve Alloy has been in the industry now for over 20 years. He's been with Mutual of Omaha for 13 of those years. He was practiced law beforehand, still actually has his law license, so everyone be careful. Right. But really, he finds the insurance side a heck of a lot more fun. And we're honored to have him here. I won't go through his alphabet soup because I'll get it wrong. But he has quite a few designations, extremely well and proficient understanding the business world and the planning world. And he is, like I said, he'll talk a little bit more about himself and what he does, but he's part of the advanced planning department of Mutual of Omaha. And this is one of the resources that you have access to by working with us to be able to, talk to people like Steve and understand the value of the carriers that we work with and how they fit in your product portfolio. But without any further ado, I'm going to pass the stage on to you, Steve, and then I know we'll do some interactions and some chats afterwards. But sure. Steve, the floor is yours, and it's an honor to have you here. And thank you for spending your time with us.
Well, thank you, Nathan, and thanks everybody for joining the call today. I'm glad to be here. Glad to have the opportunity to talk to you all. And this is a concept that I could talk about, almost without end. If you ask people that know me, they would say yes, that's definitely true. We're going to talk a little bit about business planning in general, but kind of focusing particularly on what we call the living benefit buy sell. It's a concept that we've been presenting to business owners with the idea that business owners have a multiplicity of needs, and this living benefit buy sell can really work on several of them, or at least a couple of them at once. I should mention too, as far as resources, a lot of this presentation, not all of it, but a good part of this presentation is actually contained in a client-approved presentation that is available to use with, I think it was developed to use at live seminars, but last couple, it was developed, shortly before live seminars kind of disappeared. So it's been used, I know, on Zoom and even in one-on-one situations. So a lot of these slides, again, I've changed a few of them for, agent purposes or producer purposes, but a lot of these slides would be available that you could actually use with clients. So let's talk a little bit about business planning in general, and what do we mean by the living benefit buy sell? I think to do that, we've got to first talk a little bit about buy sell agreements. I know you probably know about buy sell agreements, so I'm not going to spend a lot of time going into details on that. But I'd like to show why we like this living benefit buy-sell structure, for the right person. I mean, all the buy-sell structures work and they all make sense, but for the right situation, this living benefit really, solves a few of the problems. And then I'll talk briefly about some of the other planning areas that we can assist in the business area. And actually we go beyond, we go into estate planning and other types of planning as well. So talking about traditional buy-sell agreements, and you're going to see these people a few times here. Let's say we've got a father-daughter business here, a family business. They want to keep it in the family. So typically, a buy-sell in general, the concept of a buy-sell is, a lot of you are probably know this already. Basically commits the business owners and their heirs to either sell their interest in the business or buy the interest in the business at the death of one of the owners. Gives the family the proceeds as a way of funding that purchase and a way of making sure that business continuity happens, and that people that you wouldn't really necessarily want to be business partners with are not, that you're not forced to be business partners with them, that you have the funds to buy them out. So, and typically life insurance, there are a few ways that you can fund a buy sell, but life insurance, if you think about it, really is the best answer, because it leverages the money. You can really get that buyout for pennies on the dollar versus a dollar on the dollar, or if you're borrowing the funds, even more than a dollar on the dollar. So you really get it for pennies on the dollar, and probably most importantly, it's available. It's pre-funded. It's available whenever you need it. And the problem is you don't really know when you're going to need it. So whenever you need it, the funds are there. So there are a variety of different buy-sell structures, but the most common, and really most of the various structures, are one of these two. Either a cross purchase, where basically each owner owns a policy on each other owner, or it's what's called an entity purchase, where the business, or sometimes it's a trust, or sometimes it's an insurance only LLC, but some entity owns one policy on each owner. So those are the two basic structures. And so let's say we've got Mark and Jen here. Mark is 60 and Jen's 35. Father-daughter business. They wanted to create this buy-sell to make sure that the family continuity stays in the business. Attorney drafted the buy-sell agreement, and they did the right thing. They're funding it with life insurance. They did it as a cross purchase, and that's going to fund the buy-sell. That's going to protect the buy-sell. So what's wrong with that? Really nothing is wrong with that, but let's think about this. Are they more likely to retire from the business than to die while they still own the business? I can answer my own question there. I've seen quite a few actuarial studies where all of them said that any given business owner is more likely to make a living exit than to die while owning the business. Some of them, depending on the age of the owner, ironically enough, the older the owner, the more likely they are to make a living exit. But some of the studies were like 2 to 1 that they were more likely to make a living exit. So you think about it. Okay, if you've got just death benefit, because unfortunately, a lot of buy-sells are funded with term, and term works. I mean, if somebody dies, term pays the same as any other insurance pays. But for that living exit, term doesn't really provide an answer for that or solution for that. If they were using a policy that built some cash value that they could then access in a tax advantaged way, that could answer the living exit problem, and also provide some funds along the way in case they had some issues or wanted to access those funds along the way. So another problem that comes up with with buy sells. And, because one question that come up, okay, well, let's say they do permanent policies, they do cash value policies. Why can't they do a cross purchase and fund each policy, adequately to build cash value? They could. I have seen some businesses do that, but it's a little more difficult if somebody other than you owns a policy on your life. Because even if you do that, even if you're using, let's say you're using a permanent policy that builds cash, and let's say that the two owners agree to fund each other's policy in a way that's going to, max funded or close to max funded, in a way that's going to build some good cash. Transferring that money just because they don't own the policy that insures them, transferring that policy or surrendering the policy and transferring the money could create a pretty big tax event for that business owner. There are some, there are some creative CPAs out there. There might be some ways to reduce that or mitigate that. Could take it as part of basis, for example, but there's a potential for some big tax issues that could come up to the recipient of the money, or even the owner of the policy who transfers the money, or the company, or you might have more than one involved in creating a pretty significant taxable event if you've built some good cash. So that's kind of a disincentive to do that. Well, that's why we kind of like this living benefit buy-sell agreement. And that's what we call it. I mean, you may have seen this in other contexts where it's basically a buy-sell agreement where the insured owns their own policy. So it's not like a cross purchase where, say, if Nathan and I run a business, I'd own a policy on Nathan, Nathan own a policy on me, that'd be a cross purchase. In this one, Nathan would own his policy, I would own my policy, and you'd fund it. If I wanted to build cash and Nathan didn't, or vice versa, we'd fund it however we wanted to fund it. In order to meet the requirements of the buy-sell agreement, though, we would do a collateral assignment for some or all of the death benefit. I say some or all because one of the nice things about personally owning my policy is, let's say that this business that we own is worth, 500,000. So and we're 50-50 owners, I need 250, but maybe I'm personally insurable for 2 million. Well, I can get a $2 million policy. I'll collaterally sign 250,000 of it, and the rest of it, goes to, spouse, kids, whoever, other beneficiaries. So you can assign all the policy, or you can assign some of it to the other owner or to the company itself. It depends on how the business is structured. Some would have to go to the company itself, but some can go to the individual other owner or owners. And the nice thing about that is you're building your own cash and you control all the other living benefits within that policy. And I'd say the slide says with some restrictions. The basic restriction is that given the collateral assignment, you may have seen collateral assignments with bank loans and things like that, where the assignee, in those cases, the bank, but here it'd be the other owner, would have the right to say, hey, I don't want you to access the cash, or they might be able to, to stop, just to make sure that the policy stays in force. So there is that restriction, but given, the permission of the other co-owner, if you wanted to access some of the cash, certainly if you're exiting the business, that would make sense. And I don't think the permission would be withheld, but even along the way, I mean, if it's something that's not going to lapse the policy, that probably would still be allowed.
Hey, Steve,
nice
to jump in right now, and you may be getting to this a little bit later, but with what you're seeing right now with the collateral assignments and cross-sell and the type of policies that are being sold, I'm sure everyone knows, most people know this if you're in the small business world, but what would you say and I know this isn't going to be an exact statistic, but how many policies are funded by just term insurance that don't have any living benefits with them. Would you take a guess?
Oh, it's a high. I don't know an exact number, but it's a very high number. I would say of the buy sells, if just going by the number of calls, like the ratio of calls that we get, I would say it's got to be 3 out of 4, maybe more, maybe 80%.
And that's what I wanted to bring to attention here with what Steve is going over, is that's where you have that competitive edge of understanding, the living benefit portion and doing something a little bit different, especially with the idea of the collateral assignment and people owning the owners owning their own policies. That's not a concept that a lot of agents and advisors are using. And so just be aware of that as what you're going along, because that's really what we're trying to do in this information, is give you some other tools and things that you can jot down and have some conversational competence with this. We can help fill in the back end of making sure that we, dot the I's and cross the T's, but you have to be able to sell the concept and idea. And that's really what this information is for. So for those taking notes, those are some really good points to be able to write down and talk about, of how you can recommend to do something a little bit different, which is what I'm really excited about, because the small business world needs better information, needs people like yourself to be able to help out in those arenas. But I digress, Steve. Back to you.
Well, no, that's a great point, Nathan. And I think that this really does give you a competitive advantage, because, if you think about it, a lot of the business owners that you're talking to, they may be thinking in terms of, okay, I know we got to get insurance for this buy sell. I mean, a lot of the buy sell agreements specify that they need to get insurance. So, okay, I'm required to get insurance on this. And they're thinking in terms of term insurance, and they see it as an expense. Well, using this concept, they could take that expense and turn it into a supplemental retirement plan for themselves, and enjoy it more than like not enjoy, saying, well, this is something I'm going to see a benefit out of this, whether I live or die. I mean, if I die, obviously the family is going to see the benefit. I'm not going to, but if I live, I'm going to see a benefit out of the way I'm handling this policy. So it really changes the whole conversation. And, as I was talking earlier, kind of solves a couple of issues, because a lot of business owners are kind of counting on the value, the sale of their business as their retirement fund. And, sometimes that works, sometimes it doesn't. So, if they can supplement that with something like this, with a LRP, if you will, that also is their buy sell policy, it's a great way to get multiple uses out of the same dollars. So absolutely. Another nice thing too, go ahead. Right?
No, I would say absolutely.
Well, and by owning their own policy, they avoid that potential taxable event for themselves, for the transferor. I mean, that seems the least fair of all, that the guy who transfers the policy has a taxable event, but there are some situations where that would happen, or the company has a taxable event. By owning your own policy, it's taxed. Its withdrawals would be taxed the same as any other individually owned policy. You could access the funds in there tax-free via policy loans. You could surrender down to basis. A variety of different ways that you can get the funds out. And if you know that you're going to get these funds tax-free, the business owner is probably more likely to fund this in a way that is going to build cash rather. So, it's a good potential to build that tax advantage income, really tax-free income. But, compliance likes it when we say tax advantage on the slides, but they get access to tax-free through policy loans. That potential, I think it winds up exciting a lot of business owners, because they see something that, hey, this was going to be an expense. This is going to be a kind of a nuisance. Well, now it's not a nuisance. It's I'm going to get this money. I'm going to use this money in retirement or before retirement, even down the road. So it becomes more of an interesting thing to them. So you may think, all right, well, that's so good. There's got to be a catch. And there is a little bit of a catch. There are a couple of small ones that you do have to do the collateral assignment right. If it's a corporation, it's got to be to the company versus the other owner. But probably the only real, the bigger catch is that because you're assigning benefits under the policy, it's almost like a split dollar economic benefits split dollar policy, in the sense that the one that you're assigning to, the assignee, might have, I think would, there's a split on whether this really constitutes a split dollar policy. I'm not sure it does, but I think it's probably a better practice to treat it as if it does, because then you won't have problems later on. So the assignee, to the extent of the death benefit that's assigned, would receive an economic benefit of, based on their, and it's calculated on table 2001. It's based on their age and the per thousand of death benefit assigned. So, okay, there is a little bit of taxable income because you've been assigned, this death benefit, but better a little bit of tax each year, and it's it's really not. It's not that big an amount. If you really look at table 2001, it's not that big. Better a little bit of tax each year than in retirement. I think, hey, I've got all this cash I can access, and oh yeah, by the way, it's all going to be fully taxable to you because that wasn't your money that went in. You have no basis in the policy. It's like, well, no, that's a rude surprise. This is much better. So, all right, there is a little catch, but it's not a bad one. Not a bad one at all. So let's look at an example here. Let's look at their father-daughter company, ABC, let's call it ABC Company, Mark and Jen's. They're 50-50 owners. Let's say it's worth $500,000. Jen's 35, healthy, married, two young kids. Mark is 60, healthy, married. One of the kids is Jen, so he's got kids, but they're grown up. They're on their own. So what needs do they have? I mean, they may have a variety of other business needs that we can look at. They may want to do a key employee or an executive bonus, or, one or another of the other business strategies. But just thinking in terms of their buy-sell agreement, they've got, obviously, the buy-sell funding is one of their needs. If they think about it, they probably are not adequately protected for income replacement. I've worked with, as an attorney and an advisor and home office, worked with an awful lot of business owners over the years, and there were probably a few that were adequately protected for income replacement, but most were not. The vast majority were really relying on the business. And that's, in working with business owners, that's kind of the good news and the bad news. Their business is, sometimes they see it as it solves all problems. It's their retirement fund, it's their checkbook, and sometimes that works. So yeah, I mean, that can work, but it's a lot better, I think, to have, a second plan, just in case maybe you can't sell the business for what you would like to sell it for, or that maybe, hey, I don't need income replacement insurance because, hey, my spouse will have the business. Well, if the spouse has never worked in the business, is their income really going to stay where it has been? Probably not. So, that's a need, whether they recognize that or not. I mean, that is something to discuss with business owners, is that, you're probably not thinking about income replacement, but, maybe you should. Also, right in there with income replacement is retirement income, because again, if they're looking at the business as their primary retirement vehicle, and maybe they've got a 401k that they're funding, but they're really looking at the business as providing most of the money. It might, and sometimes that does. I have seen that work. That sometimes that works, but I've also seen it not work where maybe you couldn't sell the business right away, or the business, once that owner was out, maybe wasn't worth what it would be worth with that owner in. And they've also got some issues on long-term care. So let's see what they can do. Let's break out Jen here. Jen, obviously, she wants to protect her business ownership interest. Wants to protect her family. She's got some issues with income replacement as well. She wants to be able to buy out Mark at his retirement or his disability. And she's wondering, well, how can I do that? I don't have enough money to buy him out, which is outside funds. How can I do that when he's ready to retire and to buy him out? And speaking of retirement, I mean, she's young, but she's thinking about retirement, wants to save for retirement as well. Well, properly funding this is our income advantage IUL, properly funding one of those, she gets to the point where, say she funds this until she's 65. Now, if Mark's already 60 and she's 35, he's probably going to be out of the business before she turns 65. But let's say she keeps funding it because she wants to use that for her own retirement. Well, she would have the ability, just using this ages 66 to 100, she would be able to take out 2.8 million in 80,000 per year for those 35 years. So and actually, as you can see, she's got some money left, so she could take more. We never like to illustrate down to the lapse guard. I mean, the lapse guard is there, and I'm glad it's there, but it's a heck of a thing to show a business owner, because you can show them, hey, look, if you fund this, you're going to make 80 grand a year for until you're 100. They'll still see that lapse guard, say, wait, I'm paying all this, and when I'm 90, I have $2,000 worth of insurance. No, we don't want to do that. So, I mean, it's good that it's there. It's a nice stopgap, but we always illustrate taking out less than you really could. So could she take out more? Yeah, she could. So, but at least 80 we know works and leaves a pretty good death benefit at age 100, 1.6 million at age 100. So not a bad strategy for Jen. So let's take a look at Mark. I mean, Mark's in a different situation. He's older. He's probably going to exit sooner. He's not in a great hurry to leave, but he's 60s, relatively soon. In the next decade or so, he'll probably leave. He maybe has put money into the business, like a lot of business owners his age. He's probably reinvested in business and built it up, and really wasn't, aggressively funding retirement. So now he's thinking, okay, well, I'm 60, I'm going to retire in, next few years. I need to catch up. I got to do a catch up here. Business is going pretty well. I can afford to put some in, but I need to catch up with my retirement savings. Obviously, he wants to protect his family as well, and his business ownership interest. And he's starting to think about some of the chronic protection, or some of the chronic illness or long-term care issues that could come up with him. So you see now he's going to have to fund it a little bit more than Jen will, because he's got a shorter funding time frame. But if he funds it properly, you can see that he can take out $60,000 a year for 20 years. So but for I guess that's 19 years, it'd be 1.1 million, and still have a decent death benefit left, still have cash value. He could take more than that, kind of like Jen's illustration, still have a decent death benefit left at age 95. So this could be a way to protect his business interest and protect against income replacement, and actually build retirement income replacement with by taking these distributions. And it wouldn't have to take 60 a year. He could take all of it at once if he wants, but if he wants to kind of make it last, he'd probably take a little bit each year. So in summary on this concept, it's a great way to build cash value for retirement, but also, for business needs, because you don't need to be 59 and a half or, don't need to be any age to access the cash. As long as if the cash is there, you can access it. You do have to build the cash, but you don't have to wait until you're the right age to take it. And also you never have to take it too. It's not like you reach 72, you got to take it. Well, no, you don't. You're also, you don't have limits on contributions. You don't have, I mean, there are MEC limits on the contribution based on the face amount. So if you're really maxing out the face, or you're getting as much face as you really can get from underwriting, in a sense, that's a limit to how much you can put in, but you don't have those preset ERISA limits. It's the MEC limit is a lot more flexible because maybe you can justify some more death benefit. So no, and you're not, it's not like, unlike a Roth or something, you're not income excluded. So you can make, however much, you can make $1 billion a year and you could still do this. You have the potential to actually not only get tax-free income in retirement, but actually lower your tax liability in retirement. Because if you think about it, and this is actually another seminar that we have available that you can use with clients on minimizing taxes in retirement. If you do something like this, and most of or a good chunk of your income in retirement is tax-free, then that might mean that you pay a lower tax or maybe even no tax on Social Security. So you might wind up, really, benefiting your other income by creating something like this. And of course, with life insurance, you got the death benefit protection for the business, and he would have the chronic illness benefits, or they both would. I mean, our policies include terminal illness rider, which most policies do, and also include a chronic illness rider that can be accessed, if needed. So it also has various other living benefits. In addition to the terminal and chronic illness, it has, if it's properly funded, there's a guaranteed refund of premium in years. 15 through year 15 is 50%. Year 20 to 25, you get 100% of the premium back. So hopefully that'll never happen, because that would mean you had 20 or 25 bad years in the market. So that'd be pretty bad. So hopefully that won't happen. But if it does, worst case, you can at least get the premium back from our grow rider, guaranteed refund option rider, which is included also. Cash accumulation is tax deferred growth. So it's similar to, it's tax deferred like a qualified plan or an annuity, but you're not limited by what you can put in. Tax advantage, really tax-free retirement income. Again, no income limitations. You can put in as much as the policy can hold based on MEC limits. You can do this however much income you make. You won't be excluded from this, and no age restrictions on the distribution. So if you say, hey, I want to retire at 50, okay, well, if you got the cash in there, sure. Yeah, you can retire whenever you want. You can access the cash. Or if you're 45 and you say, hey, I need to access some of this cash to expand the business or buy a new house or, do whatever. Okay, well, assuming that won't lapse the policy, business owner can do that as well. So it's a way of really solving several different problems with the same policy, with kind of making the dollars do multiple things, which I think a lot of business owners would appreciate as well. So even though I've talked primarily about that idea, we do have other business planning that we work on. I'd mentioned briefly key employee. And of course, that's a company owned and company beneficiary, really designed to put money into the company to keep it going in the event that a key employee, an important employee to the company is lost. Could be the owner, could be a non-owner. We do a lot of work. That's probably, if I had to pick our most common business planning call, it's key employee. And I which is interesting because I think that most businesses don't have that. I think most businesses are missing that. A lot of them know about qualified plans, know about their buy-sell funding, but I think they're kind of missing the idea that, hey, if one of your key people isn't here, isn't that really what makes your business unique? Is the service you provide, the things, and who's doing that? Well, it's your important employees. And so if that's what differentiates you from the competition, if that's what makes your business successful as opposed to other companies that are doing the same thing, probably makes sense to put some insurance on those people, to put money into the business to keep it going until you can replace them and bring their replacement up to speed. We also do a lot of work in executive bonus. And if an employer, if a company wants to retain an important employee, maybe somebody that would qualify for key employee status, sometimes a good way to do that is with an executive bonus. It's a selective benefit. It's you can do it. You can do it. We've had a couple of companies that they decided to do this on everyone, and they're doing it. They weren't huge. They had like 5 to 10 employees, so it wasn't like hundreds or anything. But they decided to do this rather than do a qualified plan, just because it was easier. They could fund it at different levels. They could, variety of different things they could do. So that's actually an option too, that a business owner who maybe wants to avoid some of the paperwork and the restrictions in qualified plans can actually do an executive bonus program and, kind of achieve not only achieve the same thing, but actually help the employees build ultimately tax-free income in retirement rather than stuff that's going to be taxable. So that's an area we do a lot of work in too. We do a fair amount of work in split dollar. It tends to kind of go with the seasons. Right now, we are getting a lot of calls on split dollar. For a while, we weren't. Of course, and we work both the economic benefit and the loan regime strategies of split dollar. And just a quick note, not to divert too much, but if you've got clients that are executives with a not-for-profit, one of the great strategies, well, let me back up. If you've got clients that are executives with not-for-profits and they want to create some kind of either retirement fund or deferred compensation, unfortunately, the tax rules on deferred compensation for nonprofits, very, very restrictive, much worse than the rules on for-profit. Essentially, once they no longer have any responsibility in the not-for-profit, essentially the year after they retire, they're fully vested, which means if you put aside, $1 million deferred comp, well, guess what? You have taxable income of $1 million that second year. Most of them didn't. That's not what they wanted. So I think a good strategy, if you've got somebody like that wants to defer some compensation, a good strategy is the loan regime split dollar. Works really well for nonprofit executives. So yeah, certainly if you got any cases like that, bring them in. That's another of my favorite strategies as well. And then we do a lot of work with business succession. And we do business valuations that they're informal valuations. So it's not something they could take to the IRS and say, well, they told me it was this. The IRS won't care probably, but they're good valuations for planning purposes. We work with a company called Biz Equity that you may be familiar with, that to put the valuations together. And we've had several where either they wound up selling the business or they got sued or whatever, and they had to do a formal valuation. And we found that the formal valuation that they paid a bunch of money for came in. One case it was right on target with what Biz Equity had. Another case it was about 5% off. So, these are good valuations for planning purposes. So those are good ways. I think that's a good way to begin the business planning conversation. If you got a business owner that you're kind of wondering, well, what direction, what should I talk about? I mean, sometimes doing that valuation and they see the value of the business, sometimes that really opens up a lot of the different conversations. They might say, well, I didn't know it was that high, or I didn't know it was that low. What can I do? Well, there are some strategies. In fact, we give with the report, we give some strategies on what they can do to increase that value or to build more assets in their column prior to retirement. So we've also got a ton of resources that are available to you. And certainly, if you wanted to reach us, I mean, give Nathan a call, or and we're glad to help out with any of these. We've got, well, we call it the blog. It's really more of a newsletter because nobody can respond. Nobody can respond. So it's not technically a blog, I guess, but twice a month we put out a short article on either a sales idea, or sometimes the last year and a half has kind of been a lot of breaking news. We covered a lot of the PPP loans and things like that. So there's been a lot of current events going on the last year and a half or so, but a lot of times we'll talk about a concept or a sales idea or something that's pending legislation sometimes. So maybe let Nathan know if you want to be included on, we have an email, we send it via email. So if you want to be included on that, maybe let Nathan know and he can give me a list. We also are doing podcasts, audio podcasts, where we take a deeper dive into some of the concepts and talk in a little bit more depth about them. We did one on this living benefit buy sell. We've done them on the 7702 changes, the new MEC limits. We actually did two on the new MEC limits. We did one that talked about doing 1035s based on those new limits for both cash building and protection policies. So, some good strategies that are available as a result of those, the higher MEC limits now. Those right now are coming out once a month. I think we're probably going to go to more of a quarterly schedule on those next year, but certainly, and again, you can get on that distribution list as well. It's essentially the same distribution list as the blog. So if you get on one, you're on the other. These are all also available on our page, on our sales professional access page, which is being revamped right now to make it a little bit easier to access. So hopefully this will be something you can get to fairly quickly. We've also, if you can see on the slide here toward the bottom, a business planning presentation. That is a succession planning presentation that's approved for use with clients or prospects, as is, and we have maybe 3 or 4 other presentations that are approved for use with clients. And that talks very generally about some of the questions, if you're thinking about business succession, some of the issues, some of the concerns that would come up and that the business owner should be aware of and should talk to you about. So it's kind of nice if you're, if you have a meeting of business owners, this might be a nice way to, talk, to raise the concept in a way that would really apply to all of them. Because, buy sell wouldn't apply if somebody's a solo owner. Some of these may or may not apply to different situations, but that succession planning presentation would really apply to any business owner. We also have, and these are going to be on our sales professional access page as well. We have short, like 2-minute prospecting videos that you can direct the client to, as these are client approved as well. We've got more than this. I think we've got 3 or 4 of them now, but these two, and you can see we see Mark in both of them here. So we tend to use the same pictures over and over again. But the say if you like this living benefit buy sell concept, but you're saying I'm not sure how I would introduce that to the business owner, could actually just show this video, this 1.5-minute video to the business owner, and we'll at least get the basics of the concept out, and see if there's basis for going forward. So, and the minimizing taxes and retirement one's the same way. If you say, hey, I like that concept, I don't know how I can do it and succinctly, well, have them watch the video. That'd be a way to get the idea in front of them. And of course, we have other video or other resources, I should say, as well. We have prospecting and follow-up postcards that you can use, and a lot of brochures, a lot of different concept brochures that you can use. Some are for your information, for your knowledge base, but most of them can be used with clients as well. And probably my favorite resource, the best resource is us. This is our advanced markets department. Certainly, you can contact us, you can contact Nathan, and Nathan will get in touch with us. But yeah, we're glad to work with you on any cases you've got going forward. We're glad to assist, and look forward to working with you in the future. So I don't know if we've got time for, I don't know if anybody has questions, or we have time for questions there, Nathan? Or...
We do, actually. There's a couple questions, and then I'll give a few tidbits as well that
okay.
We're good. But first and foremost, Steve, thank you for your time. That was great information. There's a few things that I want to ask about that I've seen that a couple people have raised their hand on or shot me a message about. So one I'll ask on here, let me bring it up. It's one of the questions is, isn't it better to keep the life policies for business and personal needs separate? For example, if you had access to the chronic illness benefit on permanent policy, that would cause problems if you're using one policy for both a buy-sell agreement and personal needs. What is the solution that you would recommend in that case? Would a collateral assignment solve that? Because I know you kind of briefly covered the collateral assignment. So,
yeah, and that is a good point. And that's why as much as I like this concept, I don't know that it's going to work for everyone. Because I think if using the collateral assignment, again, the assignee would have the final say on, can you access this cash value? And if it's a situation of like the chronic illness that really is going to spend down good part of the death benefit, or has the potential of spending down a good part of the death benefit, that might be an issue. So I appreciate that. That is a good concern. I think though that you can do it as part of one policy, particularly if it's individually owned. So I think that does free up, as opposed to having a company, say if you're doing an entity purchase or if the other owner owns it, because that at least makes the lines clearer, and the tax-free nature of those chronic benefits clearer than if it's owned through the company or through a trust or something like that. But that is a good point. And you're going to run into clients where it does make sense to separate the policy out. But if you got somebody that this concept could work for, I think it can work to have it all in one. But no, I understand the problem, because particularly with the chronic illness, that could have a serious impact on the death benefit.
And I think on that side too of just come up with the solutions and ideas, the concept is to give you you as agents a better tool, a better mousetrap basically to talk about. The actual planning side of what ends up need to be happening for each individual or each company or each business that you're working with may be different. And that's a great example of, splitting that business need and personal need is definitely something that can be addressed. But usually the hardest part is getting in the door. Right. So on that note, I was thinking of a couple questions or things that you can ask that are kind of those buying questions that if you can get them to answer affirmatively, then you should be able to get your foot in the door and get to the next part, which that's what Steve and the advanced planning market and our team and the affiliate marketing offices that you're working with, that's what we're good at, is we're here to fill in the gap of the any knowledge or expertise that you need. But the hardest part is getting in the door. So, and Steve, you can correct me if I'm wrong on a question like this, but things like if I can show you a way to decrease your tax liability and give you potentially tax-free income in retirement, is that worth a 15-minute conversation?
Yeah.
So
Oh yeah.
That's the kind of thought process that like everyone here, like thinking of a question or two within that gets your foot in the door and allows you to have the conversation. And I know with I know Steve breezed through the resources, but they have documents that gives you every question that you should ask about the buy-sell agreement to make sure you're collecting the right data. Because if they don't have one, then you need the information to say, well, golly, it's like a foregone conclusion that they need something like that. And if they do have one, then doing an analysis on what they have and being able to bring up, like a question like that, or asking about living benefits. So do you have the old type of life insurance or do you have the new life insurance? That allows you to get in the door and gather that data. And then we have a team of people with everyone here that can help you analyze that and give you the right information to go back to them and say, this is why you need XYZ thing.
Yeah, no, I agree. I think that makes sense. And that, by getting in the door, and to the previous question, when you're sitting with the business owner, you might decide, hey, it doesn't make sense to combine these two needs in the same policy. It makes sense to split it out. Well, but hey, at least you got the appointment maybe by talking about the concept. So
yeah, absolutely. Another thing that was asked is just going back to the collateral assignment idea of what that looks like, because I know you briefly skimmed over it. Can you explain, maybe just another minute or so on the idea of that collateral assignment, how it works within the business, and why that's something that's valuable to bring up? Because it sounds like a lot of people are familiar with buy and sell. A lot of people are familiar with key man, how all that works. But the collateral assignment idea, it sounds like it's not something that is as familiar. So if you can just take a deeper dive into that for a minute, that'd be great too.
Sure. Yeah, basically, a collateral assignment is where the policy owner is assigning some of the death benefit, some or all of the death benefit, to some other entity. Usually it's a bank for business financing, or for a bank loan or mortgage or something like that, where they're collaterally assigning. I mean, they've got a named beneficiary, maybe it's a spouse or kids or whoever, but they're collaterally assigning before the death benefit would get to the beneficiary some of the death benefit. And the way the wording in ours, and I think most collateral assignments, it says as their interest may appear. So quick example on that, say you've got you're taking out a $500,000 loan, and the bank says, well, we need a $500,000 policy. So you get a $500,000 policy, collaterally assign the policy to the bank. And it's a form, it's an additional form that you'd fill out. And Mutual would keep, in the home office. And let's say years go by and you've paid the loan down to 200, and then you die. Well, what happens then is, when the death claim is submitted, we see that there's a collateral assignment. Mutual then finds out how much is still owed on the loan, and that much goes to the assignee. The rest goes to whoever the beneficiary was. So, and that's why, and certainly, this can work if you've got, maybe you've got a policy that has a face amount higher than the loan amount, or higher than the business value. So that's a way of, making sure that part still goes to the regular beneficiary. So it's basically, and with that assignment, the assignee has some rights, has limited rights. I mean, basically has the right to approve cash withdrawals, and cash, like major changes to the policy that way. And again, if it's between business owners and it's not a complete surrender of the policy, usually that wouldn't be a problem getting that permission. Sometimes it can be if it's a commercial lender or something, they might not let you have access to it depending, but even there, if it's not going to jeopardize the death benefit or put the policy in jeopardy of lapsing, they usually approve that as well. So I don't know if that answered the question.
No, that's helpful, especially the idea that with the collateral assignment, that even if the death benefit is triggered, then not all of it is going to whoever was collateral assigned, only what is the value of whatever was needed.
Right. And that's why, a lot of times we'll get calls and, they'll say, well, it's taking out a loan. They said we should name the bank as beneficiary. I said, no, don't do that. Name, spouse, kids, whoever, charity, whatever you want to do as beneficiary, and then collaterally assign it to the bank. Cause you might, what if you pay this loan way down and you only owe 100? Well, you don't want to give them 500, do you? So,
I know for those I know for those that are familiar with that, that's old news, but for those that are getting into that business planning world, that concept of collateral assignment, that is if someone's going down that path as a business and they just did what Steve said, if I'm going to name this company or this bank as my beneficiary, like that's a huge save on your part, that you've added a tremendous amount of value, saying, well, no, there's a better way to do it. Instead of naming it beneficiary, let's collateral assignment. And that's something that comes up when you're doing business analysis and you get the information about the buy and sell agreement, you see the beneficiaries and see how it works. That's a very easy one that you can come back to and says, I noticed this on the policy. This is something that needs to be changed like ASAP.
Right.
So that's good to know as well. Right. I know we have a couple minutes left. Let's see, someone just asked another questions. In reference to the buy-sell review, the process of moving the policy from the buy-sell to personal ownership, is that done by assignment?
If if they've already got a policy in place and maybe it's a cross purchase.
Yeah.
That would be a little more difficult to undo. I mean, in a situation like that, you'd probably be better off applying for new policies.
Gotcha.
Because that, by transferring the ownership, you may trigger some of the taxable events that I talked about. Now, again, it's always good to have a CPA as your friend, because sometimes the CPA will say, well, their basis in the business is really high. We can just take this out and call it a return to basis. Okay, you want to do that, fine, but not every business can do that. And some, if they can, that could work, but it might be easier a lot of times just to apply for new policies.
Yeah. Well, wrapping up then, because I want to keep everyone on time so they can get on with the day. So lots of resources. We went over the buy and sell concept using living benefits instead of just a blank term policy that a lot of business owners have. That's traditionally how buy and sell is done, is through term policies. There's lots of opportunity in the small business world to be able to provide that level of solution. Today is more about increasing your conversational competence so that you can go out and talk to business owners about that idea. I think one question that everyone should be writing down that you should keep in their back pocket is, if I can show you a way to decrease your tax liability and give you potential tax-free income in retirement, is that worth a conversation with me? Mutual of Omaha has a bunch of resources, and there is a lot of other things that they have access to that they went over. So get in contact with your affiliate marketing office, your business development advisor, our team as well. We will make sure that we get the information out to you. And then I see a couple people asking for the presentation and things like that. So
sure. Yeah.
That's something that we'll get out to you. So we will get that out to you. This is also recorded, so this will be sent out also. And Steve, really appreciate your time. We would love to have you on again and talk about some of the other concepts and ideas that Mutual of Omaha has. And you guys also have the advanced market department, their email and their phone number is right there. So Bug them, not us. I mean,
Yeah, please do. I mean, that's, that's why we're here.
yeah,
If we don't get calls, they wonder, what do you guys do?
yeah,
So call us.
absolutely. Well, Steve, a pleasure. Everyone have a great rest of their day. Last other thing I do want to mention too, if you are not contracted with Mutual of Omaha, this is something that you should have in your product portfolio, not only for this reason, but a slew of other product lines that they have. We'll have touch base with you and talk about the process and get that going. But in the meantime, everyone have a wonderful rest of the day. And we will have another webinar like this in 2 weeks' time. Of course, you guys will get the registration for that, and that'll be on a different concept than what we're doing here. So appreciate your time. Everyone have a wonderful day. Thank you, Steve.
All right. Thanks. Thanks, Nathan. Thanks, everybody.
All right. Bye-bye.
All right. Bye.